Put the spotlight on cement space this time. Despite of monsoon, cement prices actually edged higher in many regions of the country, and the stock prices on the markets also. We've got Sandip Ghose, Managing Director at Birla Corp, and we also have, along with that, Navin Sahadeo, Research Analyst at ICICI Securities, joining us to help us understand the market context of it. Thank you very much, gentlemen, both of you, joining us on the show. Mr. Ghose, is the demand scenario stripping supplies and also the monsoon situation disruption, that even despite a monsoon, we saw pricing edging higher, at least parts of the region in South and many others? What's the scenario like on ground?
See, there are two things. When you talk of monsoon, weather has become very unpredictable nowadays. So August, which is usually affected by monsoon, was a very good month for the cement industry. It saw not high, but close to middle double-digit growth. But September has been a dampener because there has been rains all over the country, and pretty heavy rain, so there has been dislocation. So September, in fact, you might find the volumes to be certainly much lower than August, and compared to last year also, the growth may not be significant at all. So, it's not really the question of demand outstripping supplies. Demand has been healthy, and that's been the projection, which Mr. Sahadeo will also say that throughout the year, the industry had predicted, and analysts have predicted about 9 to 10% volume growth. But the issue on prices really is, if you see, the prices have remained flat for now almost a year. And that was despite the sharp increases in costs last year post-Ukraine, in the fuel costs especially. Now, though fuel costs started normalizing by the end of the third quarter, and it's remained, continued to go down, remain soft. But the industry's other costs went up, which they were not able to pass on at all. And now we are also sitting at the cusp of a time when oil prices are once again beginning to heat up. And as I said, other costs have picked up. So the industry does not have an option but to look at some price correction. Cement industry has always been, I think, it's got the wrong end of the stick, saying that they have sharp price increases. But if you see normalized over a period of time, cement price increase has been extremely modest, if you see in a normalized way. And so if today they don't increase the prices in the coming months, you will have the delivery in terms of profitability and in terms of what are the investment plans of various companies, you can have pressure there. So I see some correction happening, but it is certainly not going to be a runaway correction.
Mr. Sahadeo, how are the valuations of these stocks trading at? No price hike for last 1 year, and now normalization happening. Are they in attractive zone versus their long-term average?
Have already seen a pretty decent run up. So all the large caps, I think, trade anywhere between 15 to 18 times EV EBITDA. And even the smaller names, I think, trade in excess of 10 to 13 times. So this is very much or slightly higher than their long-term range.
That you like, Navin, as a recommendation, which is your top bet right now?
So we'll go for pockets where we find value. So rather than a direct exposure, what we are recommending is play the cement story through Grasim, because that's where bulk of the value comes in. So currently, I think the holdco discount is fairly high, almost about 45 to 50%. The other story which backs our positive reco on Grasim is that the standalone entity, which is VSF and Chemicals, is bottomed out. At least in China, we are seeing from the bottom, there is a 5% plus kind of a recovery in both these prices, caustic soda as well as VSF. Cement, as we know, demand continues to remain good, of course. And the fact that pricing sentiment is improving, that should be a good tailwind. And lastly, the paint business is just about to start anytime soon. I mean, in fourth quarter. So that should be a good value unlocking that should happen as they progress successfully into the paint segment. So large caps, we are recommending Grasim, and the mid cap plays we find JK Cement to be very attractive.
Sandeep, the other leg of the story, right? That's the input costs. I mean, both crude as well as petcoke prices have seen a fair amount of escalation. How do you think that's going to play out on your balance sheets?
This question to me?
Yes, Sandeep, to you.
Yeah. Okay. Now, you see, crude and petcoke prices have firmed up a little, but I don't think it has reached any alarming stages yet. But what I mentioned to you that, since last year, when most companies went into the red in the first second and third quarter, it has not really, the profitability has not gone back to the pre-Ukraine normal. And whereas other costs have, in fact, inched up during this period, and there could be a possibility of, again, fuel costs firming up, because we already see that there is heating up in the international oil market. So cement companies will need correction to get back, the price corrections to get back to a normal profitability, which the market is expecting from them. So that would mean a certain amount of, has to be their price correction. Initially, at the beginning of the year, most analysts had said there'll be volume increase, but not too much of price correction. But I see that changing in the second half of the year. And right now, when some of the stocks which you have, indicated, where you're seeing certain regions, especially the East,
Sure.
had a huge price drop earlier, and now that is getting corrected. So that's why you saw some of the names you put up on the screen I was seeing. Those are the East-based companies who will see higher, profitability correction right now. And therefore, I think people like Mr. Sahadeo are putting in more confidence in some of those stocks.
Sure. So the eastern, facing companies are doing a lot better. But for yourself itself, given the demand and the supply dynamics that we talked about, are you on track to achieve that 850 rupee per ton kind of EBITDA?
We are still maintaining that projection, because we see certain developments happening, especially limited to us as well as on the market scenario in the second half. As we all know, people in the cement industry bank a lot on the demand during pre-election season. That would, I think, that volume, that demand is yet to pick up. One should see that will kick in, I guess, from next quarter. And if with that there are price corrections, and then I said there are company-specific, factors. With that, I think we are maintaining our 850 projection. Near about 850 is what we have said.
Are you also maintaining a 15% volume growth kind of guidance, or given that election, the pre-election volumes are going to kick in, it could be 15 to 20%?
I don't think it'll go up that high. No.
But at least 15% then, or even that is looking difficult?
We are fairly stretched on our capacities. Okay, some of our existing units, only place we have to ramp up is a new unit which has come up in Maharashtra, Mukudman. But if you look at our other existing units, some of them are operating at close to 100% capacity. So we are not seeing that sort of a ramp up for us specifically. People who have got spare capacity, who have added on new capacity during the year, they might have. So therefore, some names you have mentioned, they have, I think, headroom for a higher increase if demand supports. But we are quite happy with our, 12 to 15% kind of a growth.
I mean, that's the other thing, right? Although you flagged off that going via the holdco route and via Grasim is the best cement play right now. But just wanted your own perspective on the capex which is lined up for the year or next 2 years ahead, and whether a second round of price hikes, say in the month of October, could be absorbed by the market. Is there enough demand?
Yeah, so because these are two unrelated questions, so I'll take about the pricing part first. So I concur with Sandeep ji that almost for over a year, the industry has been reeling under the pressure. In fact, last year was probably one of the worst years for the entire industry because given the sharp spike in fuel cost, all thanks to the Russia-Ukraine war, they could not really pass it on to consumers. This year, I think there is definitely a good chance. We've already seen that sort of recovery after a very sharp drop all the way from January to August in the eastern region, especially. September has indeed given a good recovery, and I think the expectation is pretty much ripe for a similar sort of a recovery even in the southern market. So even in other pockets like north, central, and west, you will see increases happening in the range of 10 to 20 rupees beginning October. So demand is clearly supportive for sure. And I think the environment itself is pretty much conducive for the entire industry to take the price hike in the month of October. Now, how long it sustains is a $1 million question because historically what we have seen is sharp spikes especially don't last beyond a couple of months, but what it does build up the overall realization base much higher. So it's nonetheless, I'm saying, becomes directionally positive for the sector, so to say, at least from a near term perspective. On your other question about capacities, so yes, there is indeed a huge capacity built up happening. There is Adani Cement, there is Ultratech who's executing phase 2. I think very soon they'll come up with their phase 3 expansion. There is Shree Cement, which is going all out, and many names. So I think if next year FY25 we are expecting 35 million tons of addition, 26 I think looks pretty promising from even a 50 million ton plus kind of a capacity addition if all the plans, if companies are talking, have to be executed. So I think from a capacity addition perspective, there is pretty healthy pipeline, and that's where the caution comes in because this year is pre-election demand. But last time, in let's say, I'll draw your attention to FY20, where the demand after elections was just about flat. FY19 had seen a 13% growth. So I think similar kind of a thing could possibility, because this year the demand is anywhere 11 to 13% growth seems very much possible at an industry level. Next year, if it slows down, then that might require some caution there.
Yes, that $1 million question is on the sustainability of both the pricing power and the demand. But Sandeep, just coming back to the discussion with you on the capacity side, you had laid out some big targets of 30 million, 30 MTPA by 2027. Which are the areas you're building up more capacity in, and how are you going to fund this?
See, funding will happen first level organically. We are wanting to keep our debt level, which we have mentioned, at more or less the current level there. And then our second phase, we'll have to see how it goes to 30 million. We were originally saying 25 million by 2025. We are behind that by about a year or little more than a year because our earlier expansion ran into the whole COVID period, and therefore we are coming there. So we have, I wouldn't call our plans conservative, but we have a fairly steady plan. We are not going in for those big numbers which some of the bigger players or even some of our peer group are looking at, because we have to consolidate our profitability. And that's why we are focusing more on what we'll do on the EBITDA delivery, both in per ton basis as well as in absolute terms. And once that comes in, and we have got certain major cost savings planned, and I don't want to dwell too much upon it because we are getting into the sensitive period, but especially say on captive power, in terms of captive coal mines, we'll have one of the highest component of captive coal mines in the industry. So those initiatives are in place. And so we will focus first on getting our profitability up to the levels which we aspire to, and then look at further, need for raising funds or not. But that'll come closer to the time when we have to, take those decisions.
And I'm guessing this profitability improvement is what you're talking through that project Shikhar as well. So what's the update on that? And you were also going to tell me where these capacities are coming.
No, we are, as I told you, our clinkerization capacity will start only in 25, 26. Right now, our first phase, what we have to do is we are looking at optimizing our new plant, which is in Maharashtra, and which we are on track in terms of our projections, how we are taking the utilization there up. And then thereby we are trying to optimize our go-to-market, our supply chain, for our core market, which remains, as Mr. Sahadeo said, essentially central India. We're very strong in UP, we are very strong in Madhya Pradesh, and then aside in Rajasthan, parts of North, we are now, due to Mukutban, we are able to address these markets in a much more comprehensive manner. Because when we look at this entire footprint, which is in the center, we have now got this additional capacity, which is just below the center, from which we can service the lower part of central India, that's large parts of Madhya Pradesh, extending all the way up to South Gujarat, which is a very, very high growth and profitable area, which we were earlier not able to reach from our existing capacities in Chanderia, which is in Chittor. So now all those areas open up, and our existing capacity, which was there in Madhya Pradesh, our Maihar, and then Satna, through which we were supplying, say, south of Madhya Pradesh, that can be utilized much better in our core markets of Uttar Pradesh and central Madhya Pradesh and western Madhya Pradesh. So those give us higher realization. And in the next stage, therefore, we'll have to optimize on that, and we'll go in for grinding units closer to the market. We have certain plans for that, which we have discussed earlier. And once all that happens, I think we'll be in a better position to go for our second line expansion in Maihar, which is what we have talked about from 25, 26 onwards. Shikhar is just one of the initiatives. Shikhar, we are looking at about 50 rupees per ton already by the end of this quarter. Will kick in from Shikhar, but there are many other things which are in the pipeline. One of the bigger things which I mentioned to you is our captive coal mines, which are coming on stream. One major one will come on stream by the end of the year, end of this fiscal. We have Sialgogri, which is near Chhindwara, which is in full stream. And then there'll be further additions to our thing. And we will be, therefore, as I told you earlier, that one of the highest, we'll have the highest component of captive coal through captive coal mines. And if the prices, international coal prices and what you indicated, those go up, then I think that'll give us a competitive edge over many of our peers, even in the same region.
Right. All right, Mr. Ghosh, Mr. Sahadeo, thank you very much for joining us with that take on the sector.